Hey everyone, George here. So here's a fact. One IRS letter can cost contractors thousands. And here's another fact. For the most part, audits aren't random, they're triggered. So in today's episode, I'm breaking down what gets contractors audited and how to bulletproof your books before the IRS shows up. So let's get started. So what is an audit, in the context of your contractor business? An IRS audit is an examination of your tax return and your business activity. The IRS is trying to confirm that your return accurately reports your income, deductions, expenses, credits, and here's the part most people overlook. Auditors aren't just checking numbers, they're evaluating credibility. Meaning even if your expenses are real, if your records are a mess, it can create suspicion. And in construction, messy paperwork is extremely common because you're busy running jobs, paying crews, ordering materials, and trying to keep projects moving. So think of an audit like this. It's not about what happened. It's about what you can prove happened. So who gets audited and why are contractors higher risk? So for the most part, audits aren't truly random. Small business owners are more likely to get audited than W-2 employees. And the reason for that is because business owners have more deductions, more flexibility in reporting, and more opportunity for errors. So the reality is if you stay in business long enough, there's a decent chance that you'll get audited at least once. And here's a warning that matters. If the IRS audits you and finds irregularities, you may be more likely to get audited again. So if you did get audited just that once, you don't just want to get through the audit. You want to avoid creating a pattern where the IRS sees you as an easy target. So how does the IRS pick audit targets? There's something called DIF scoring. One of the most common ways the IRS picks audit candidates is through computer scoring. The IRS uses a scoring process that uses tax returns and assigns a score based on audit potential. The higher the score, the higher the chance that your tax return gets reviewed. And for contractors, the biggest concept to understand is this. The IRS compares your ratios. They look at the relationship between your income and different categories of expenses. Basically, if your return looks off compared to industry norms, it can raise your audit score. So if you report $180,000 of income and you have $165,000 of expenses reported, you might be fully legit, but your return looks suspicious to a computer program. And the computer doesn't care that you had a slow year, one bad client, or a job that went sideways. It just flags you. Now, the key point is it usually takes more than one issue to trigger an audit. But when the deductions are aggressive, plus the income seems low, plus something else looks inconsistent, that's where problems start. So why do Schedule C contractors get audited more? So if you're a construction contractor operating as a sole proprietorship or filing a Schedule C and reporting your business income there, you should know this. Sole proprietors are audited way more than other business entity type. Now, partnerships, LLCs, and S-Corps can absolutely get audited as well. But Schedule C are extremely common audit targets because usually deductions can be high, documentation is often weak, and reporting is often inconsistent. So if you're a contractor running everything through a Schedule C, first off, I would recommend a better entity election. But more importantly, your paperwork needs to be clean and defensive. The IRS also targets certain industries through what you could call special focus area. These are market segment or industry programs where the IRS puts extra attention on certain businesses. Construction often falls into higher attention because it frequently includes a heavy use of vehicles or trucks, tools and equipment, subcontractors, job site travel and mileage, and a lot of times cash deposits. So even if you're honest, your industry is in an elevated risk bucket. So that doesn't mean you're doomed or anything. It just means you need to be prepared. There's another method that you can be triggered for an audit, and that is through informants. A disgruntled employee, subcontractor, business partner, bookkeeper, someone who knows their numbers can tip off the IRS. And now not every tip becomes an audit, but tips can absolutely start investigations. And that's why having messy systems and messy books can become a problem. Because if someone complains and the IRS wants to take a look, you don't want to be caught in a weak position. So let's talk about amended returns and refund claims. Contractors sometimes file amended returns to correct mistakes, add expenses they missed, or claim refund. But amended returns can raise the chance of audit review because the IRS may ask, why are you changing this return? So amending is not automatically bad, and sometimes you just have no choice. But if you amend the return, you need to assume that this return can get extra attention. And your documentation needs to match every number you're changing. Because if the amended return gets audited, the IRS can end up looking at more than the exact line that you just changed. Now let's break down the two main types of IRS audits that contractors see. There's oftentimes office audits versus field audits. So an office, also known as a correspondence audit, is usually the most common type. It usually starts with a letter where the IRS starts requesting proof of certain items like receipts, invoices, bank statements, mileage documentation, and proof of deduction. These audits can often be handled by mail and sometimes by phone. And a lot of the times with these types of audits, the IRS is focused on a specific category like vehicle expenses or certain other deductions. Now, the second type of audits are field audits, and these are more serious. This is where an IRS agent conducts a deeper review and may want to meet in person, oftentimes at the business location. Field audits can be more intense because they can ask broader questions like how do you collect money? How do you pay for subcontractors? How are jobs tracked? What accounting system do you use? How do you separate business and personal expenses? So this is where contractors can get into serious trouble if they're disorganized. So if you get a field audit notice, that's usually the moment you want to stop winging it and actually bring in professional help. So here's something important to note. If you've been audited once, that does not mean you're safe going forward. In a lot of cases, it can make you more likely to get audited again, especially if the IRS found problems, the IRS assessed additional tax, or the next year's return still looks aggressive. So your goal isn't just to close the audit. Your goal is to make your next return cleaner, more consistent, and more difficult to challenge. So what should contractors do to stay audit-proof? So if you do these things, you will drastically reduce your chances or your stress during an audit. Number one, separate out your personal and business expenses. No mixed spending, no all sorted out later. Just have your personal expenses on one card or bank account, which is completely all your personal, and your business expenses on another card, another bank. Number two, keep real documentation. So if you deduct it, you should be able to back it up with real receipts, invoices, logs, bank proof, job notes, calendar invites, things like that. And generally, any expense over $75 you want to keep a receipt for. Again, I always recommend just snapping an Apple or Google photo picture of the receipt itself, and you can discard the receipt. You don't need to keep the actual pen and ink receipt. Number three, be careful with high deductions. So it's not that taking large deductions is illegal or anything, but they're most likely going to be called into question. The larger the deduction, the higher the chance that it's going to be questioned. Number four, don't ignore IRS letters. So ignoring notices makes everything worse. And there's ways you could delay the process. However, if you ignore them completely, eventually they can put liens and levies on your account. And number five, get help early. The earlier you handle an audit correctly, the easier it goes. Waiting until the IRS is skeptical of everything is the expensive way to go about it. So if you've gotten IRS notices or any of this applies to you, you have any questions, our calendar link is down in the show notes. Book a time, we're always happy to speak. And in terms of how long the IRS has to audit you, I have an episode just on this, which I'll be putting up right here, and hope to see you in the next one.